In this lecture, we cover the basics of sales and use tax. In later lectures, we will go deeper into the subjects covered here. The objectives of this first lecture on sales and use tax are to introduce the rules for state sales tax, introduce the rules for state use tax, introduce the concept of seller nexus, and introduce the Streamlined Sales and Use Tax Agreement, or SUTA. Let's first define sales and use tax. Sales tax is a tax imposed by states on gross receipts from retail sales of products and services. Because this is a tax on gross receipts, a seller may be liable to collect and remit this tax even if the seller is not profitable. Sales tax is ordinarily imposed only on in-state sellers. In-state sellers are sellers making sales in a state from premises in that state. For example, sales tax would be imposed on a local store when it makes over-the-counter sales to customers. Like sales tax, use tax is a tax on gross receipts. It is ordinarily imposed on the same types of gross receipts that are subject to sales tax. Unlike sales tax, use tax is ordinarily imposed on buyers for use in a state where the product is purchased from an out-of-state seller. Even though use tax is imposed on the buyer, the out-of-state seller must collect and remit the tax if the seller has nexus in the buyer's state. If the out-of-state seller is not required to collect the use tax because it lacks nexus with the state, then the buyer must remit the tax. For example, if an online seller from out of state does not collect use tax on a taxable product, then the buyer is supposed to calculate and pay the tax. Let's look at how sales and use tax is calculated. In general, both sales and use tax are calculated as a percentage of the sales price of a taxable product or service. In general, the sales tax is imposed at the same rate as the use tax. There are exceptions, but this is the general rule. The tax is imposed only on taxable products and services. These are products and services specifically designated as taxable in the state's relevant statutes and regulations. Let's talk briefly about the states that impose the tax and those that do not. Nearly all states impose some kind of sales and use tax. The rates can vary widely among states, as can the products and services that are taxable, but the basic laws and practices are similar as between states. There are a handful of states that do not impose a state sales and use tax, and these states are New Hampshire, Oregon, Montana, Delaware, and Alaska. Some towns in Alaska can impose a local sales tax. The mnemonic for these states is NOMAD. Let's now turn to the subject of seller nexus. In general, a seller is required to collect a state's sales and use tax in a state only if the seller has nexus in the state. The rules for seller nexus changed dramatically in 2018 with the Wayfair case. Prior to Wayfair, Nexus required physical presence in a state. An out-of-state seller had to have physical presence regardless of the level of sales in the state and regardless of any other factors that a state may determine are relevant for Nexus. After Wayfair, physical presence is not required. The leading case that sets the physical presence requirement is Quill versus North Dakota. In that case, a mail order company, Quill, sold substantial numbers of products to customers in North Dakota. The state asserted that Quill had to collect the state's use tax, despite the fact that Quill had no offices or personnel in the state. The court held that Quill had to have physical presence in the state before the state had the right to require Quill to collect tax. As a side note, the court acknowledged that Quill did have de minimis physical presence in the state, in the form of a few computer disks that customers used to order products electronically, but that this de minimis presence was not sufficient to meet the physical presence requirement. In 2018, the Supreme Court determined that an out-of-state seller, Wayfair, had Nexus in South Dakota, even though that company had no physical presence in South Dakota. The company did, however, have substantial sales in that state. The court concluded that physical presence was not necessary as long as the seller met the state's requirements for Nexus. This case then overturned the Quill physical presence requirement. Among South Dakota's requirements are the seller must have at least $100,000 of sales in the state in a year, or at least 200 or more separate transactions. As we will see, in addition to these rules for Nexus, if a seller has registered under the Streamlined Sales and Use Tax Agreement, the SUTA, then the seller must collect tax in any state that is a member of the SUTA. Let's now look at what is and is not subject to sales and use tax. In general, tax is imposed on tangible personal property unless specifically exempt from tax, and is not imposed on services unless specifically taxable. Most state codes are written so that all tangible personal property is taxable unless specifically exempted. Exempt property can include, for example, medicine and food. Most state codes are written so that services are not taxable unless specifically designated as taxable. If a state is a member of the SUTA, then the taxability of its products and services generally corresponds to the SUTA. However, the SUTA always allows each state to identify certain products and services as either taxable or tax exempt, so that the taxability of products and services can differ widely among SUTA states. Let's complete this discussion of the basics by looking at self-imposed use tax. As noted earlier, an out-of-state seller must collect use tax if the seller has nexus in the buyer's state. If there's no nexus, then the tax is not collected. When this is the case, the buyer ordinarily must self-impose tax and remit the tax to the state. Many states require buyers who are individuals to calculate this use tax and pay it with their state personal income tax returns. However, in many cases, this use tax is not paid by non-business buyers. That is, there's a substantial lack of compliance by individuals. Business buyers, on the other hand, ordinarily comply with the requirements to self-impose use tax, especially if these buyers sell products and file sales and use tax returns. Now let's discuss the source of sales and use tax rules. Each state imposes its own sales and use tax based on its own sales and use tax statutes, regulations, rulings, and court cases. State law is sometimes limited by federal law, especially in the case of interstate commerce. For example, the ability of states to require out-of-state sellers to collect tax is restrained by federal law. Under Wayfair, mentioned previously, a seller with substantial economic nexus in a state can have nexus in that state. Under previous law, Quill versus North Dakota, nexus required physical presence. Both Wayfair and Quill are U.S. Supreme Court cases and represent federal law applicable in all states. Another example of federal law is the Internet Tax Freedom Act, which prohibits states from imposing sales tax on certain online services. The SUTA is an agreement that states can voluntarily sign on to. When they do, they agree to amend their own state laws to conform to the model laws included in the SUTA. Thus, while each SUTA member state imposes tax on its own, based on its own laws, subject to limitations of federal law, its laws are modeled on the SUTA. Now let's try a comprehensive example to give us a good idea what we are dealing with in this unit. Webco is a retailer of toys. The company sells toys only through the internet and is not affiliated with any other retailer or manufacturer. All of the company's offices, personnel, inventory, web server, and other equipment is located in Oregon, a state that does not impose a sales or use tax. That is, the company has physical presence only in Oregon. In addition, Webco has minimal sales in State B, the state where we will be considering its requirement to collect tax. The company sells to Jones, a State B resident. State B imposes both sales and use tax on toy sales. Prior to Wayfair, because Webco had no physical presence in State B, the state could not require Webco to collect use tax. Also, sales to State B are relatively minimal, and after Wayfair, there's not sufficient economic activity to create nexus under a Wayfair type rule. Webco does not have State B nexus, is not required to collect use tax, and has not collected the State B use tax. Because use tax is not collected, the state requires Jones, the customer, to self-impose the tax. However, in many cases, if the customer is an individual buyer, he or she will not impose the tax, and the tax will go unpaid. Now let's change the facts in this example to make Webco a seller registered with the SUTA. Once again, Webco is an internet-only seller of toys. Webco has decided to register with the SUTA. In later lectures, we will discuss why it may be advantageous to do so. Once again, Webco has physical presence only in Oregon and minimal sales in State B. The company sells to Smith, a State B resident. State B imposes both sales and use tax on toy sales. State B is a SUDA member state. In later lectures, we will discuss how states become members of SUDA. Ordinarily, WIPCO would not be required to collect the State B use tax because it does not have physical presence in that state or its sales are minimal. However, as we will see in later lectures, because State B is a member of SUDA and because WEBCO has registered with SUDA, WEBCO must collect State B use tax on the sale to Smith.